Welcome to Pierpoint Perspectives, the Securities Finance podcast delivering commentary from the best, brightest and most innovative people in the world of securities lending, repo, collateral management and related areas. Pierpoint Perspectives is brought to you by the consulting team at Pierpoint Financial. So now, over to your hosts.
Hello and welcome to Season 2, Episode 1 of Pierpoint Perspectives, the Art of Securities Finance. I'm your host, Roy Zimmerhansl, and practice lead at Pierpoint. Yes, we survived Season 1. We did 15 podcasts on a broad range of subjects. 8 of the episodes were with external guests, adding a different flavor with their own thoughts and views. In Season 2, we'll be challenging ourselves to up our game, both on the production side and the content side. So we hope to continue to bring you interesting and informative guests and add our own insights into the mix. The opening guest for this season seems a fitting one. He was our first external guest in June, and that remains the most listened to episode of Season 1. Since he was on, the trade association he leads has done a couple of their own podcasts. So not only was he a great guest last time, he's now a podcasting professional himself. It's been an interesting few months, and I'm sure that will give us a lot to talk about. So let me introduce my guest, the Chief Executive Officer of the International Securities Lending Association, Andy Dyson. Good morning and welcome back, Andy.
Roy, good morning, and good morning to all the listeners. I'm absolutely delighted to be back again. I'm not sure how long it is since we last did one of these, but time seems to have whizzed by. But actually, a lot's happening, and I think this is a great opportunity to talk a little bit about some of the things that we're seeing and doing in the market.
Well, yeah, so listen, thanks for being our opening guest for Season 2. Hopefully you are our lucky charm. It's been 4 months, actually, just over 4 months. And think of what a 4 months it's been. So I think that will come out from some of the things we talk about. And in fact, just a quick one, we did the session just before you started the ISLA ISF virtual conference series, where I was fortunate to have the wrap-up session with you as well. So I don't know, how do you think that went as far as an event? And I guess people can see the episodes on your website. Is that right?
Yes, Roy, thank you. We did the event in the summer, as you suggest, and I think from our perspective, we were absolutely delighted with the way it went. And I think I might have said this before, but we sort of figured out quite early on that obviously people come to events for lots of different reasons. And prior to COVID and the pandemic, there were great reasons to come to many of our events. There was the social networking, there was, the very kind hospitality provided by some of our sponsors, and there was that whole socialization and social thing. Obviously, when you move to a different world, virtual events rely on one thing. They rely on the quality of your content and your speakers. And I think that we were able to gather, a very, very good and consistently high quality series of discussions and groups and panelists. And what we found is that actually, quite perversely, is that, first of all, it's somewhat easier sometimes to get speakers to join you because the commitment tends to be, for 1 hour or whatever, rather than would you like to travel to somewhere else in Europe to do a speaking engagement. And secondly, we also saw that the ability of people to join sessions who otherwise wouldn't have been able to travel meant that we were actually able to reach a whole new audience. So I think as we go forward, first of all, we've got another event that we're working on our own, sort of in very early December, that I think we'll come to a bit later on. But secondly, I think, we recognize that we're in a world now where the virtual delivery of events will become a regular feature. And I think it will be a regular feature of events, even if we get through a post-COVID world, because people suddenly recognize that the medium works, the technology works a lot better, and it does provide a different sort of demographic an opportunity to attend. So we were delighted with the event. And I think, the feedback I've received was very, very positive.
Great. Yeah. Look, I thought it was great. I even referred back to one last week. That's why I know that they're posted on your site. So they're great reference material throughout the year. So thanks for posting those as well. And I guess that's also part of the difference of an in-person conference where the panel sessions might be fantastic and good interaction and questions, but they're kind of dead to the world from there on. This is kind of a living legacy of information.
Yeah, and that can be good and bad, Roy, depending on what you say on the thing that's recorded, of course, because some of the things you say today will come back and haunt you. But I do agree with you that, we've got this increasing library of material, that's available for people to retrospectively look at, and if their question comes up around, what was said on a panel 6 months ago, you can actually definitively answer the question by just looking at the session online. And I think that's something also is a great source of, if you like, intellectual property that we're making available to our members and wider stakeholders. And as we do more of these, that library of content will grow and grow. And it does mean that people doing research or understanding, where markets were a year ago against like today, for example, they've got that increasing well of information that you're quite right. Some of the sessions we did in our pure, face-to-face events, once they're gone, they're gone. I think what you might see over time, if I'm honest, is almost a hybrid developing where you may have a live session with a limited audience, but you'll also stream that to a wider group. I see that becoming more of a feature, particularly when, we're able to be a little bit braver around events in that post-COVID space into next year.
Yeah, but look, I think the combination is most likely, as you say, because there is huge value in the face-to-face elements of any event. So hopefully the two can come back, and hopefully you get back to Austria next year, and we can all celebrate.
Let's hope so.
Right. The other thing that was on the cusp when we met last time was SFTR. So over to you. Give us an update, your thoughts, the progress, the next steps. Where are we?
Yeah, okay. So, as many of your listeners will realize and understand, that we had some sort of delays around the implementation of the first phase of SFTR. I think I might have said our perception was that, the that extra time was used very wisely by the industry to do, more testing, more validation. Our vendor community worked very hard to make sure that on day one, the tier one firms, were able to start reporting their new trades. And our expectation and understanding around that process was it went pretty well and continues to go pretty well. There's always going to be, the odd teething problem around, data points missing, but feedback from the trade repositories has been generally positive around, first of all, the submission of data, and the sort of the matching of data. Now, before we get overexcited about the matching of data, you've got to remember that, first of all, in that tier one phase, you had essentially the borrowers being reported by the borrowers because the institutional investors and the buy side weren't obliged to start reporting until more recently in early October. Now, obviously, we also have a community, particularly in securities lending, where a lot of the, if you like, the loan side of the transaction would never be reported under SFTR because it comes from, lenders who sit outside of the European Union. And that sort of thing will exacerbate as we go through Brexit, because we've then, rather than having a unified reporting block, we're going to have a split reporting block. Having said all of that, as we went into early October and the buy side began reporting, I think early evidence and anecdotal feedback is, again, that's going pretty well in the context of, inevitably there's always that little bit of a challenge of making sure the trades are all in the right place at the right time. But the general experience and feedback is that this has gone, relatively very well compared to the implementation of other reporting regimes. And I think let's pause on why that is. First of all, I think we have to pay a lot of credit, give a lot of credit to ESMA and the colleagues that we work with at ESMA, in terms of their approach. They not only had a mandate to deliver the level one text on behalf of the legislators, but they also recognised that they were working with an industry from our perspective who wanted to be proactive and also deliver on those obligations. So I think we had a really, really good and strong partnership with the colleagues at ESMA and the relevant national competent authorities underneath them. So I think that partnership worked well, and I think ESMA have publicly stated that more recently, that the role of the trade associations in the context of SFTR has been an absolutely crucial sort of game changer in terms of the difference between success and failure. I think from our perspective, we called it out very early on that this was going to be something that needed a lot of investment and focus, and we committed a lot of resources for our association early on in the process, and I think that's paid off in terms of delivering best practice and also consensus through our working group structures. So as we go into sort of almost the reflection phase, and now we're seeing how it's going, it's going, I think, we hear pretty well. Is every trade matching in the system? No, but actually, I think those problems are now well understood and being managed. So, as we go into the end of this year into next, we can't ignore SFTR, but I think from our perspective, it becomes a care and maintenance business as usual thing, which is where it should be in its life cycle. We will continue to devote considerable resources to that and provide a very important forum through our working groups to allow market participants to come together and discuss ongoing issues, because something as complicated as SFTR will throw off challenges from time to time. And I think I would also just sort of highlight the work we did through the working groups led to the development of best practice, and we've deployed that best practice in a very different way through a interactive, searchable series of functions on our website that allow member firms to inquire of the system particular points they're looking to understand in a bit more detail. And we've still got regular working groups that pick up the things that are not routinely already covered. So I feel that if we want to point to success, I think it has been a success. We're not quite over the line yet because there's always work to do, but I think it's gone pretty well.
Yeah, I recently moderated a panel on digital transformation, and it was quite an interesting discussion because kind of in the first part of the SFTR related discussions, we were saying, well, of course, the industry came together because it was forced on them. There were regulatory pressures and compliance obligations. And so the industry came together. And then the conversation morphed into and said, yes, while that's true, it actually has been successful because firms chose to focus on it. And I think that's where trade associations and the firms really, really shone. The reality is they did step up to that challenge and do more than the minimum. Not everyone, but many.
I think also, listen, a regulatory imperative is always a good reason for change because it's staring you in the face and you need to make sure you're compliant. But I think I would say, generally, we saw our members embrace the process and say, okay, we've got to get some stuff done here. How do we get this done in a way that is actually provides a bit of a springboard for future things? Because if you look past SFTR, you can immediately see, and you mentioned the session you moderated, what that means to a broader digital and other efficiencies agenda. And there is no doubt, without SFTR, we wouldn't be doing some of the things we're doing today in the digital space, because firms would not have been able to allocate the resources around SFTR that they did, other than the fact that that was coming out of the regulatory compliance budget line, because you had no choice. But the good thing is, after quite a lot of advocacy from us and my colleagues within the association, I think that people understood that there was an opportunity to get this right and go a bit further, and I think that's what we're now seeing.
So I'm going to put you on the spot now. I'm going to ask you to give an interim early report card rating on SFTR.
I'd say that, listen, we're clearly, okay, so good question. I'd say personally that we're at a 7 or an 8 in terms of, the early days. There's still some unanswered questions about backloading of data and trades, but I'd say that we're at a 7 or an 8, but probably a 7.
And as you said before, I think that stands up pretty well to many other regulatory implementations
And
over recent
Roy, let
years.
me just say one thing, right? The way it tends to work, and we've seen this time and time again, I've seen this time and time again, is when it goes badly wrong, we tend to hear a lot about it, right? But when it's going okay, we tend not to hear much about it. And as I haven't heard much about it, the inquiries I've made on the basis of that, my sense is it's going pretty well.
So I think that's a great way to look at it. Look, I got a text message on day one where someone I know said, "Do you realize that the following firm hasn't reported a single transaction?" And that's one text so far that I've received. So I would agree that even anecdotally, I haven't heard any sort of horror stories. And if there was only a problem on day one, I think that's a major success.
Yeah, and we all know with these big reporting regimes, there's a general expectation it's going to be relatively chaotic because if you wait for it to be perfect, you're going to wait forever. So there is a point where you've got to almost close your eyes and press the button and see what happens. And I think the industry collectively did that, quite rightly so. And the experience has been okay. I mean, I'm not for 1 minute suggesting there haven't been some headaches or people getting very stressed from time to time, but we're not seeing the wholesale meltdown that we've seen with other similar regimes in the past.
Right. Speaking of wholesale meltdowns, I think that's a perfect segue into the next part of the conversation. Again, when we last spoke, the lockdown had been implemented, and we had obviously the market turmoil in March and April. That was all very fresh in our minds. It's a few months further down the road. Any other further reflections on that, or thoughts, or feedback,
Um,
or anything interesting?
yeah, so I think, listen, when we saw that original sort of market turmoil, February, March, Um, on the back of some very, very volatile movements in equity markets, and we saw the arrival of, the big funding schemes from governments, and that changed people's behaviour certainly in the short term. And I think in our markets, as I think we might have discussed, we saw that sort of rush. There was a big rush to, if you like, finance positions. We saw different collateral coming into the mix from time to time. So therefore, I think that there was that reaction as you would expect, and looking back on it, some of the reactions were quite intense. We saw quite lots of margin calls, particularly if you were in trying to play around with equities as collateral. You're probably seeing that phenomenon where you couldn't post enough collateral to keep up with the way the markets were falling, and we don't see that very often. But listen, we saw that begin to calm down, and as we go into the sort of the final period of the year, what I think is quite curious is we're all collectively being hit by pretty much similar in terms of lockdowns and restrictions. The cases in many countries appear to be going up, not down. Um, but I think because now people are a bit more understanding of what they're dealing with, we're not seeing that feedback into such volatility in markets. I think that what we're seeing in securities lending markets is a sort of, first of all, a return to some element of normality. We've seen a few firms reporting revenues that are less exciting than they were before. What I think we don't know, and we probably need to look at that in a bit more detail, is that just a natural sort of decline because opportunities aren't there? I'm sure that some of the opportunities to, if you like, take positions around so-called COVID sensitive stocks and industries will still be there, and I'm sure that's happening. But the business seems to have returned to a level of normality. We're very confident that our infrastructure stood up to those extremes and therefore ready to, again, withstand any further shocks. And I think also more broadly, just looking at the financial services sector, um, banks are generally much, much better capitalized today than they were 2007 and 2008. And although this crisis has not been born out of financial services instability, what we are seeing is that as the crisis has lapped around, those large financial institutions, they've withstood that relatively easily. And I think that's testament to, if I'm honest, some of the work regulators have done to ensure banks are better capitalized. But it also raises other questions because I think that we did see, and it's well documented, that banks generally, for lots of different reasons, have a less appetite for risk, and people argue that means that increases volatility in markets, because traditionally banks would be that backstop and go into markets and buy positions, particularly if they saw value because things had fallen too far. And that means that role has tended to fall to regulators. So people like the Federal Reserve and even the Bank of England, were known to be actively buying securities in markets to ensure markets remained open and liquid. So that raises some interesting questions more broadly about the direction of travel for regulatory oversight and what that means for banks. And I think some of that will play out as we go into next year. But generally, I think that we saw a very robust market, certainly in securities lending. We as a small group were about to go back to the office in a more formal way in London about 2 days before we were all told to work at home again. So that's what we're doing. But my sense is, and I've obviously been talking to my board about this, is we've delivered on everything we wanted to deliver on this year, set against a very, very challenging business backdrop. So I would just say that collectively, the market and certainly my staff have done a great job of navigating the current sort of quite tricky territory in terms of markets. Because Roy, you and I have been at this a long time, and we won't have seen many years like this, if ever.
Certainly not like this, but if you're around long enough, you do experience new situations that you need to cope with. But the resilience is there, right? The key is, can you continue to have a functioning market? And I think what you're saying, what I hear you say, is that the infrastructure in securities finance and repo and collateral management, I think collectively that securities finance community has actually stood up admirably. I'm in the camp that you described, where I think that the liquidity providers these days are providers of convenience. And when it's not convenient to be providing liquidity, you have great market gaps down. And so I think we have a structural issue. So while I would agree, regulators done a great job in terms of making banks safer and more secure, as you identified, the truth is the market, I suggest, is less secure for a liquidity perspective. So I think that's a challenge for the future.
Roy, I think that's a view that I think has got a lot of validity in terms of just thinking about the way markets function, and that's a very interesting question that has got to be thought through as well, both in the US, where we saw the extremes, but in Europe, because they're busily trying to figure out how you develop the capital markets union, which is all about markets.
Yeah, but look, while you've mentioned it, where does that stand? Because obviously that's a critical issue for the European agenda for the coming years.
Okay, so I think that the Capital Markets Union Action Plan was published, I think, mid to late September, and that outlined a number of important elements to the Capital Markets Union that are to be focused on. And I think that a couple of things came out of that I thought were fascinating. The first thing was, there's a lot of focus on cross-border settlement efficiencies, and those of you who've been around a long time will remember the Giovanni discussions probably 10 years ago across Europe about how do you optimize settlement efficiencies across Europe to make sure that you've got free flow of capital and settlement efficiencies. And I actually participated in another working group 2 or 3 years ago in Europe where we looked at pretty much the same agenda. And this is a tricky one, because without that free flow of capital and efficiencies, it's going to be very, very hard to think about how Europe as a unit can move ahead as one. And I think what's interesting there is that while the politicians have been staring at that conundrum, technology has been busily evolving in the background and may actually provide them with a solution. And that solution is built around the digital agenda, because regardless of where you sit from a settlement perspective, if you're all seeing things in the same way and you're describing life cycle events and trading flows in the same way, you immediately open up the opportunity to create those efficiencies. So I think we've already demonstrated some of the work we're doing to the European Commission in the context of developing those markets more recently. And I think that resonance has worked in the context of trying to understand where those markets are evolving. So I think the CMU, the first thing there is about those settlement agendas. The second thing that came out was fascinating, and any of you who've scrutinized what the commission said, they made reference specifically to CSDR. And one of the things we know is happening is there will be a short targeted consultation coming out in the next few days that will look at elements of CSDR. And you may well have also seen that earlier this week, the Commission published its broader work agenda for 2021. And in that, they've brought forward to Q1 the overall review of CSDR. So you've got two things going on. You've got a targeted review within the context of Capital Markets Union, and a more broader review that was going to happen anyway, but they brought it forward. And the high-level experts group, which was part of the CMU process, identified CSDR as quite problematic. And you'll know that we, as an organisation, have been talking for quite some time about fines, but also the buy-in process, as have others. But I think our understanding is a couple of things have changed. I understand from, if you like, reliable sources that one of the things that has caused a bit of a pause and a rethink of CSDR is there was a piece of work that was done that overlaid the world of CSDR, i.e., if CSDR had been operational and in up and running at the time of the crisis we just spoke about, Roy, in February and March, what would have happened? And I think the conclusions of that have been have been quite startling in the context of what that would have done to exacerbate market liquidity issues. So I think there's a sudden recognition that perhaps there needs to be a bit of a fundamental revisit on some of the elements of CSDR. Listen, we as an association absolutely get that you want to have good and efficient settlement processes. You should be using ICSDs and CSDs. But I think also there's a clear, I think, growing understanding that some of those measures, although well intended, have got some quite negative consequences. And we've talked for a long time about the impact of the buy-in regime on our markets, and we would like to again have that opportunity to have that discussion with the regulators and the policymakers in Europe, because I think that without some rethinking there, that's going to be quite problematic. And obviously, on the side of that, we've already had that statement from the UK Treasury that they're not going to implement certain elements of CSDR as currently written. And one of those, I think, is going to be the buy-in process. And we shouldn't forget that when we talk about buy-ins, our market has happily had a buy-in mechanism embedded in its master agreement for 20, 30 years. So I think that there needs to be a recognition that the market has evolved to a point where it has addressed some of these issues itself. So I think, Roy, on your point about CMU, I think one of the things I've mentioned in one of my blogs is the CMU will be an agent for change across a number of different things. And in the work plan for next year also, there's some focus on securitization. That's outside our remit, of course. But they're beginning to recognize through the CMU that you need to use that as an agent for change in other areas. And I think one of the areas that's going to get a bit of focus is CSDR. And we would obviously support that because I think there needs to be a proper open debate there.
Yeah, and that's, excuse me, I think to me that's very encouraging, right? Because often what happens with regulation is it gets implemented and then people who have maybe been warning about negative impact eventually get a hearing on it, it gets reviewed, and then possibly change in view. But that's a process of years. The reality is, as you say, there is a need for better settlement discipline because interest rates being where they are, there isn't really always an economic interest in solving for that.
Yeah, and Roy, just on fines, and there's always two elements to this, and I think with fines, there's a stronger case that fines, particularly in low interest rate environments, do change behaviour. We saw that in the U.S. Treasury market a few years ago, and my sense is that if you are failing trades, and you should probably be fined, if I'm honest, because you need to get your act together. And I think we've done a lot of work through the development of best practice, where we've worked with our members to say, look, rather than arguing about we don't want to be fined for failing, let's understand why we're failing and can we do anything to rectify that. And you're going to see more of that from us, because some of the reasons you fail trades are inexcusable in my view, and I'm sorry. Therefore, there does need to be a bit of focus. Sorry, I interrupted you, Roy.
No, I think you've made my point, right? The reality is SFTR has gotten us to the stage where there's a compelling reason to resolve unmatched trades because you're required to. I think fines, because of the interest rate environment, will also drive that, because we need to have a better market. We need to have a more efficient, more effective market. And the problem that we face today is that everyone is so focused on solving for existing daily issues, fixing those breaks, that they spend precious little time saying, how am I going to fix those breaks in the future so they don't happen again? Right. And that's where the focus needs to shift. And if it takes fines to do that, then, so be it.
And I think, listen, and I know we're gonna talk about the CDM shortly, but that's one of the reasons that we've invested a lot of time and resources in the CDM, because when you talk about a spend around a technology development, some people look at it in isolation and say, is that a lot of money? Yes, no. What you've got to do is you've got to look at it in the context of the cost you're paying for failed trades. You've got to fund those positions. You've got to pay the fines. So I think what we're saying to firms is, when you look at this world, don't just look at it in an isolated way. Look at how these changes can, as you say, make the future better. And there's always that inclination. Everybody goes, well, I've got 10 people on Rex, and great, and I'd like to have 8. Well, why do you need any? If you get this right, you won't need any. So I think that there needs to be you're right, there needs to be a bit of change of thinking, and that's a couple of things that I've been working on in terms of what we should be doing as an association. But I know we're going to come on to that.
Well, let's address it. We talked about common domain model. I talked about the digital transformation panel. One of the other interesting things that came out of that, where David Schoen from ISLA was part of it. And in fact, everyone sort of, when we started talking about CDM, everyone kind of turned and pointed to him, and he dealt with it very well. Look, the reality is that the common domain model, people always think about it in the future condition, right? They always think about where we're actually going with it. And one of the good points on the panel was, the standardization and the pathway to a more efficient market actually starts today. You don't need new technology today to do things to make the market better. So, what's your thinking on that? Where is that now?
Okay, so you're absolutely right. So there's a couple of things around sort of the development of technology, and I've discussed this several times with my board and other stakeholders. Is the first thing is, look, there's always a danger with technology, and we've all seen it and we've all been part of it, is that you sort of do it for the sake of doing it, and you're not very clear on what you're doing it for other than you think you should be. And I think what we want to do is avoid falling into that trap, and I don't think we're anywhere near doing that. And what I mean by that is that we looked at where the market needs to look at efficiencies, and most of those efficiencies are in the post-trade space right now. Okay, their recs, their breaks, all the things you talked about. Right. Then you say to yourself, well, what can you do to change that dynamic? And one of the things you can do, of course, is you can standardize so that everybody sees things in the same way, life cycle events are recorded in the same way, etc., etc. So when you arrive at that world, you're immediately talking about the digitalization of trading flows and life cycle events. And what we've done at ISLA, but even there's still a propensity for people to say, well, yeah, but it's okay. Why do I need that? So what we're doing, and we set ourselves a very, very clear objective with the work we're doing today, is we said, look, we're going to identify some very specific component parts of a stock loan, and one of the component parts is the allocation. So it's a bulk trade and the allocation process. Okay, and we're going to use that and develop the relevant digital code, and then most importantly, some of the people who've clustered around that working group have very kindly said that they will take that code away and they will develop a couple of two or three test or demo solutions that use that technology, so that when we do our event that's in early December, we're in a position to say to people, look, apart from the fact this is really clever stuff and we're all talking about technology in that sense, here's some real world practical examples of how this works, and this is how it's going to change your daily life. And I think that's the point that we're trying to do a bit differently. And I don't want to talk about how others have done this, but I think, what we're a very practical group. Most of us have worked in the industry, and therefore what we say to people is we're doing some stuff, and this is what it means for you. And therefore the idea of the event is to show people what it means. So if you took that technology that we're going to be the custodian of going forward, this is what you could do with it. And I think, and therefore that has significant implications for things like costs further down the line, because we all want to save cost, and one of the biggest costs is headcount around sort of things like Rex. So I think, Roy, that's where we're being a little bit different. We've set ourselves a very specific target, limited sort of scope pilot study, and when that pilot study delivers, it will demonstrate some real world solutions. And I think that will be the key then to unlocking further engagement on this subject. If people can see the relevance to them, then I think they're going to be prepared to be more engaged. I would just say that under David's sort of shepherdship, or whatever you call it, that group has been super engaged, and we've had some fantastic support by people providing data, but also getting rolling their sleeves up and helping to work with our development partner to actually make the thing come alive. Because if you don't have that input from market practitioners, even into the guys we're using, who are a pretty smart group, you don't get that resonance. So providing that real world, nitty gritty feedback, which has always been our strength. I've always liked to think that we're a group that we get it because we've all been there, right? So providing that backdrop, I think, means that I'm very, very, confident we're going to have a great outcome on this particular piece of work.
To me, that's the right way to approach it. We're doing some research at the moment for a client project, and what we've seen is that a huge number of banks are putting considerable amounts of money towards digitalization. But what we also see in some of the research we've seen is that they don't really have any idea what they're doing with it. In fact, what we saw was that banks are in fact often more likely to make investments in technology companies and see what those companies that they've invested in are doing, rather than actually applying anything themselves, because they lack clear understanding of where they're going to apply technology to the issues they face as businesses.
I think that's a good point, Roy, in that we often sort of look at third parties, who deliver some very, very credible and smart solutions, but we also need to look at ourselves, and one of the things we've tried to do is, in a very limited way in terms of the work we do, we've tried to, if you like, think a little bit further forward. And that's why, as I said, for example, our best practice is now in an online interactive tool rather than a book. And I think that's the direction that we've got to go. We've got to make content, available, digital, and I think that's exactly the same thing, we're talking about here with this CDM agenda.
And so I look forward to that. And is that freely available? Like, can people go to your website and sign up? Or
So
what do they do?
actually, as we record this on this particular day, which is in sort of mid-October, I don't know when this is going to go live, but by the time this goes live, you will have all seen the invitation on our website, and it's a freely available event for people to join up and actually watch. During it's an afternoon type event. So by the time people see this, it should be out there.
Okay, let me rephrase that. Andy, I just saw the invitation to your event at the start of December. Really looking forward to it, and I signed up immediately.
Thank you very much.
Great. So you mentioned the working group that David is part of, but I guess there's been a series of new ISLA working groups. Do you want to talk us through that?
Yes. Okay. Thanks, Roy. So we've found as we've gone through the last 12 months that we've got some really super working groups dealing with some very detailed challenges and working with member firms. But we also recognize that, if you like, there was a couple of things missing from that structure, which was, if you like, two or three groups that almost took a step back and dealt with some of the bigger picture issues. Doesn't mean to say that these groups are going to be less engaged, but if I just give you a sense of what we've done, we've created a regulatory steering group, and this group isn't the group that's going to talk about the minutiae of CSDR or SRD2 or SFTR, because we've got groups quite happily doing that. But with key representation from those subgroups, if you like, we're going to have a regulatory steering group that just takes a step back and says, well, what does the regulatory agenda look like, covering things like SFDR, taxation, as well as ESG? And I think they'll be looking at the ESG elements across all of that, and then this is particularly relevant for people in firms who've got an overall sort of compliance or business management function, because the detail will continue to be undertaken in the relevant subgroups, some of which are giant groups. Our SFTR group is still 40 to 50 people each time it meets, for example. So I think it's going to take almost an overarching view to the regulatory agenda. We'll be able to opine on things that are coming out of Brussels and decide if that's something that perhaps a smaller group should look at. The second one is something we've done before, but then it sort of didn't happen for a bit. But we know it's there in terms of people's, if you like, appetite, is a market practice steering group. And what happens with market practice in the past is, when there's a corporate action that's gone horribly wrong in Italy, then everybody's all over it and they join our groups, and we have a lot of good conversation about where we're going to take that debate. But then that sort of tails off, and I think what we want to do is engender a little bit more sort of broader discussions around market practice, and in there we're going to have things like corporate actions, general best practice, not just best practice with regard to SFTR. The work we've done on performance measurement will be in there. We see that now as another important element to understanding how the market behaves, and we wanted to create some structure in there so that when people look at their outputs in terms of how they've done, they know that it's going to be if you like, created within a standardized framework across all the providers. For us, that's pretty standard stuff, but we know that market had been a little bit disjointed because of the way it had developed over time, and I think we were delighted to add a little bit of structure to that process. Again, it'll have an ESG element to those discussions. And the final one I want to talk about is the collateral management steering group, primarily made up of, as you would expect, custodians and the big tri-party agents. And we found that the work we did with that group around SRD2 in particular, reinforced our view that, and Roy, I think you and I were talking about this before we started the call, pretty much a lot of roads in Europe lead back to one thing, which is collateral and the efficient management of collateral. And that raises questions around things like eligibility, mobility, how you think about consolidation and what that means in terms of things like offset and netting and all those sorts of things. Though all those roads lead to collateral. And those roads are getting, if you like, bumpier because we've got the ESG element as well. Sustainability and sustainable finance, in the context of securities lending, many of the challenges and questions we have to address will be through the collateral world. So if you like, we'll be looking at collateral questions through the lens of ESG. And therefore, we've got a really good group we've gathered. And that group, I think, will be very much engaged in looking at those challenges and figuring out where you get to in terms of market consensus. And I know from the work I've done that the tri-party guys are some of the most competitive people on the planet, and we don't want to in any shape or form get in the way of that. But we do believe there's a level of consensus across those businesses and products that we can agree, if you like, market best practice or other sort of frameworks that allow the market to function more broadly. And one of the things, Roy, that I'm keen about is where we can create standardization, and that's in the form of the CDM or collateral schedules or whatever it might be. I want the market to compete on its ability to deliver products and services, not on its ability to unravel some huge mire of either plugging things together or, mapping collateral. That we shouldn't be competing on that basis. We should be competing on the basis of the products and services and the people that we work with. So that's one of our sort of developing roles, if that makes sense.
Wow, that's quite a lot of stuff going on, Andy, and I think there's a huge range of challenges. Can I ask you a question though about those working groups? Are they still all contained within ISLA members, or are any of these sort of open to wider participation, or how does that work?
Um, Generally, look, listen, good question. If you want a seat at the table to influence the direction of travel, you really need to be a member. It's as simple as that. Clearly, many of our outputs are available to non-members, but if you really want to help formulate policy and strategy, you need to become a member. And the reason I say that is not only does that mean that we get another membership in, but also if we let people in who aren't members, that's a bit of a disservice for the people that we do have as members who've paid us some money. So I think we do have a very clear policy there, which is generally if you want to be part of those groups that set those agendas, you need to be a member. And I think those members that have joined, and we've got a lot of members that have joined in the last 12 months, understand why we say that, because that means that as we get bigger and better, we can do more things. So generally that's the position on that, Roy.
Okay. So, and kind of a related question, which we haven't talked about, is board composition, right? A typical board of an organization is going to be made up of a mixture of some executives and independents. And ISLA in the past has, I think, had members on the board that haven't been or had board members that haven't been members of ISLA. Is that correct? And is there what do you see? Do you see any changes for how that works or approach?
Yeah. Obviously, if we had a board composition from history that did reflect some of those things, I probably can't comment on that. Certainly, where we are today is that the criteria for being a board member, there's a sort of a basic criteria, which is um, you need to be obviously working for a member firm, and that member firm needs to be taking market risk in the context of securities lending. Now, what that does mean is, and quite rightly, there's an interesting debate to be had here. That definition, which is on our website through our sort of governance structure, means that if you're a service provider, you wouldn't routinely be eligible to join the ISLA board. I think it's fair to say that the board are alive to those issues, and as we go through that evolutionary cycle, I'm sure that at the appropriate time that may well be revisited. I think that there is also the possibility that people could be invited to join the board, and that may allow the board to go away from those strict criteria. But right now, the composition reflects two or three things. It has to reflect, obviously, our borrowers and lenders, as well as our institutional investors. Those are the three groups that tend to take the market risk. Also, we've got good geographical representation, so we have board members representing key countries across Europe. And in the latest board, I'm delighted to see that we've got some growing and developing diversity there, which is absolutely the right thing to do. And I fully support that, of course. So I mean, obviously, that's does that answer your question?
Yeah, it does. I was really thinking more of sort of the rise of peer-to-peer activity, where you have a potential for a wider range of institutional investors that are engaged in the business and therefore are kind of stakeholders and may not actually be members, and it might be valuable and interesting to have new participants providing insights.
Yeah, I agree, and I think that first of all, we have a number of forums that are available and open to everybody where people can come along and talk about those new things. And as we begin to do more virtual events, of course, I'd like to think that we hear some of those voices. Listen, the point I would make is that also I'd make that we are incredibly busy just doing the work that the current membership demands of us. So, we're always happy to have new members, but I know some of the peer-to-peer discussions, particularly outside of our region, I might suggest fall outside of our remit, although we're delighted to have those discussions to learn more about what people are doing and saying. And if, peer-to-peer participants, feel that there's something that should be being discussed within ISLA, they can always join, and we can have that discussion. So I think that we're an open organization now. The website, I think most of the content is freely available to everybody. There's very little that's restricted to members only, and that tends to be the working group minutes and the legal opinions, if I'm honest. So I think, we're hopefully we're welcoming to everybody.
Yeah, and the reason I asked that was, I look back at the history of ISLA when it was kind of a part-time job of a handful of industry people who really drove the agenda, then through to the first kind of full-time CEO or like dedicated CEO, um, to then really under your leadership, as it's kind of expanded and professionalized and spent, a really critical decade, really, of responding to regulatory initiatives. It all strikes me as kind of a changing paradigm, and if that's going to be the case, then these sorts of questions about board composition, participation, membership, all of those things become more high profile. If you're going to be a bigger, more
Yep.
influential organization, you have higher standards you have to hit.
No, I think I wouldn't disagree with you, Roy, and to an extent, um, the board represents, if you like, a moment in time of the industry, um, and we could speculate that the industry's moved on a bit. And what I mean by that is something like the rise of the digital agenda brings new players to the table that perhaps didn't even exist, 3 or 4 years ago. And I think therefore the board working, with myself, I think we need to be alive to those changes, and we need to figure out how the board needs to respond to that to make sure that, because part of their function, of course, is they should represent the members more broadly when they discuss, what we're doing at the association, in terms of work plans and stuff like that. So I think that, that will change over time, but obviously, as we have the 3-year rolling period for each board, you're only going to get a chance to look at that every sort of 2 to 3 years.
Yeah, and I think this all kind of plays into a wider agenda. And do you see the role of trade associations changing? I mean, I think there was a huge sigh of relief when SFTR went live, and
Yeah,
although, as we said, it's not perfect, it is, it's on its way, right?
yeah.
So a big hurdle
No, I
is
do, Roy. And one of the things that is obvious to me is, first of all, um, the logical big beasts of the thing we've worked on for probably best part of 10 years in different shapes or form, they're essentially done now. And if you spoke to a politician in Europe, they would tell you that SFTR is done. It might not be quite there yet, but their view is that we're all moving on. And therefore, when you think about what we do, first of all, the advocacy world is changing. So it's not logically hitting those big targets in Brussels, such as SFTR and CSDR anymore. It's figuring out how do you play your agenda into their developing capital markets union or ESG agenda. So that raises some interesting challenges, and the messaging that we have to think about is more nuanced rather than direct. So rather than saying we don't like that for this reason, we've actually got to play into that values-based world I mentioned earlier, and that means we just got to change the way we think about our messaging. But the other thing I think is changing is we're now truly in a position where we can get on the front foot. So I see our business actually falling into three broad areas. I've talked about all of them this morning. The first one is I might call it business as usual, and that's a big business in its own right. So that's all the work we do every day on making sure that SFTR continues to work, looking at CSDR, looking at other rules and regs, as they come out of the regulatory outboxes of our policymaker and regulator friends. And obviously, there's a dynamic there around Brexit and what that's going to look like. So that's a big business as usual, and we will continue with that. And that will subtly change, as I've said, but it's still there. The two other big things that will change the way we do things will be the digitalization of financial markets more broadly. We've talked about what we're doing there. And secondly, the ESG agenda, and we've mentioned that as we go through many of the things we've talked about this morning. Those two single elements will define much of what happens across Europe in the next 3 to 5 years. And therefore, we as an association have to be alive to that. And I think it's completely appropriate that we are looking at ESG issues, something like the common domain model. The association should be the place where that lives. We should own the common domain model for the benefit of our members, and we should be the custodians of that. So our role is subtly changing, rather than being these sort of headline advocacy groups who are battling away against the big regulatory agendas. Those days are sort of behind us to an extent. There will be outbreaks of things we need to focus on. But until we see another wholesale financial crisis, the regulatory community aren't going to be that disposed to putting in more financial services regulation. So there is still a lot of work to do in that space, but we've also got to, if you like, set that against the backdrop of what's going on elsewhere in the digital and ESG space. So we are realigning our thinking along those lines, if that makes sense, Roy.
Yeah, does that change your focus in terms of resourcing? I mean, what do you think your needs
Um,
are? Like, can you draw on the community, or
well,
is it a change, or what?
Obviously, we're delighted to have someone like David Schoen working with us because he brings huge experience of common domain models in the digital space. And therefore, when we do recruit new people, we will be looking for particular skill sets. Having said that, listen, the group I have working around me are very, very capable. And I think what we've all got to do is change the way we think about things. And that doesn't mean to say that I need to change all my people. Far from it. I think we've got a great team who are ideally placed to take these agendas forward. And I would just add that we've had tremendous support from member firms as we've looked at things like ESG and digital, because they do recognize this is important and therefore are deploying their subject matter experts to help us with particular questions. So I think bringing that sort of mix and match together, I'm very, very optimistic about the future.
Yeah, and it's the depth of knowledge and experience, I think, that the team, the ISLA team really brings to it,
And I
right?
think
So
the
there's
key thing, Roy, is
confidence enough to
there's
deliver.
many challenges, but if you have a background of working in the industry, you can deal with those challenges in an empathetic and proactive way. And I think that's one of the reasons we've been hopefully successful.
Great. So listen, Andy, I'm just going to wrap up. I just wanted to know this 2020. What are you taking away? What have you learned so far? What's different? Personally, professionally. I'm wondering if you can just give us a minute or two
Yeah.
on what it means to you.
Okay, so I think if we look back to January, which seems like another world now, we've had to deal with a changing environment, whether that's personal or professional, that we could never have contemplated in January. Um, at a personal level and a professional level, I think our collective adaptability and the ability to take on things that we'd never heard of before, things like social distancing, were phrases that were just not used, and now it's front and center of everything we talk about, etc., etc. So, I think that we should all be quite proud of ourselves in terms of the way we've been able to adapt to that changing environment. You know, we can quite rightly question some of the things that our collective governments have done and the way they've done it and when they've done it. But the simple fact is that at an individual level, we've all had an element of responsibility to see our way through this crisis. And I think from my perspective, we've done that. And as far as ISLA is concerned, I'm absolutely really proud of the work and the way my team have adapted to new ways of working, new ways of looking at things. And this has the pandemic, although very much in its extreme, hasn't interrupted what we wanted to do from a business perspective. Clearly there was things that we wanted to do we couldn't, and most of those were around things like events. But you know what? We've dealt with that and moved on, and therefore, I look towards 2021 with the view that we've had to be very, very adaptable and flexible, and I think that's a testament to the professionalism of the people that I work with.
Couldn't have said it better myself, and thanks for that. Right, so that's it. I appreciate. I've taken up about an hour of your time recording, and more than that, given the chat we had beforehand. So, listen, Andy, thank you so much for sharing your thoughts. Fascinating times, lots of things changing, and it doesn't look like anything's going to be quieter in future. I look forward to the December 1st event as the next sort of milestone for you guys.
Roy, thanks very much for the opportunity this morning. It's been really, really good. Thank you.
Great. Thanks, Andy. And to listeners, I'll be back in a couple of minutes with my thoughts and reflections on this episode. So just bear with me. To you, it'll just be a moment in time. To me, it'll be a few minutes. Okay. So thanks, Andy, and goodbye. Well, the time really flew past quickly for me in that episode, but I think that was a great show, and it sets the bar high for season 2. The ISLA ISF conference was a big success, and Andy thinks that even in a post-COVID environment, there'll be an important role for virtual access events, and he mentioned hybrid sessions as a likely outcome. We then moved on to SFTR, and despite it being early days, Andy has rated the industry implementation as a solid 7 and compares it favorably to other large-scale implementations in recent years. We also talked about the market turmoil itself earlier this year, the role of central banks in maintaining liquidity, and personally, I want to revisit this issue in a further episode. Andy gave us some fascinating insights, I think, into the behind-the-scenes thinking on CSDR and buy-ins, and it'll be interesting to see how that plays out. Fines almost certainly are going to be the case, but will buy-ins survive another review? ISLA's had to deal with disrupted working conditions just like everyone else, but Andy, I think rightly, has heaped praise on his team, who've done an incredibly good job keeping everything going and moving forward rather than just sustaining things in this year, which is obviously like no other we've seen before, and hopefully we'll never see again. I really like the ISLA approach regarding the common domain model, which is very focused on solving or improving real-life situations. I think that in order to get support for further development, it will need to demonstrate real tangible value to the ISLA members and the market as a whole. We also talked about the several new working groups that have been formed by ISLA, and the areas are all ones that need and will benefit from further attention. Now, I pushed Andy a little bit about the board construction, and I think he responded robustly. My view is that ISLA needs to continue to increase its footprint globally and has to be able to stand up to scrutiny on its own governance approach. Finally, Andy described a trade association in the midst of transformation into a changing world of digitization with an increasingly critical focus on ESG issues, and it's clear that considerable thought has gone into that area. Now, that's it for the show comments. I really would like now to ask listeners to do me a favor. If you like the show, it would help us get more great guests if we had some reviews and ratings. We don't have reviews or ratings at the moment, and you can change that. So if you like the podcast, please share the love and your reviews. And if you don't like it, I guess that's okay too. I'm interested in your feedback either way. In the show notes to this episode, there'll be a link to Love the Podcast, which might make it easier for you to get the ratings if you use iTunes, Stitcher, Podchaser, or CastBox. If not, please go to your provider and give us a rating. I'm interested in seeing what you think. In any case, we have some great guests lined up, and we're excited about the shows that we have planned for the coming weeks, and I hope you'll you'll join me again. As always, we encourage you to share topics or guests that you'd like to hear from. So drop me a line at roy@pierpoint.info. And of course, our contact details are in the show notes. If you haven't already, please subscribe to the podcast and tell all your friends, every single friend you have. We provide a lot of free securities finance content, which you can find on our website, www.pierpoint.info. We are all very active on LinkedIn and Facebook as Pierpoint Financial Consulting, as well as individuals, and on Twitter at Pierpoint FC. I'm Roy Zimmerhansl. This has been Pierpoint Perspectives, the art of securities finance, and I look forward to catching you next time.